new business owners actually get the money they need to actually launch a business. And that's exactly what I want to dive into today during this training. I want to teach you everything you need to know about personal loan stacking, what it is, how it works, who it is for, the benefits it provides, and basically all the other additional insight you need to move forward, understand personal loan stacking, and actually successfully go out and obtain it. Look, if you are especially a newer business owner that has no revenue or is pre-revenue or basically has little revenue, this is really for you, because this is one of the most effective ways we've ever found to actually get the money that you need to grow your business. So what's it about? We're going to dive into it right now. We got a lot to cover, so let's get going. So first of all, I don't even like the term personal loan or business loan. And here's why. Because the reality is it's just based on one thing versus another, which is revenue versus income. If you have an existing business, your business is thriving, it's doing well, it's generating good revenue, then you probably need to look at revenue lending, merchant cash advances, term loans, SBA loans, depending on how long you've had that revenue for. But the reality is a lot of business owners I'm talking to right now are just starting a business. They're just launching a business. They're just getting going. So in this case, you are what's called pre-revenue, or even if you make a little bit of revenue, you're still what's considered to be pre-revenue. Here's the problem. The problem is a large part of financing that's out there, the majority of what's funding right now, let's say 70, 80% of it is all taking into account the revenue of the business. And this is why startups and newer businesses struggle so much to get the capital that they need, because they don't have revenue yet or enough revenue to qualify. So the minute they're out there trying to get money and they don't have revenue or enough revenue, then 70, 80% of potential funding options are gone. They're not able to qualify for those because they don't have the revenue to verify to be able to qualify. And this is where personal income comes into play. There's a lot of ways you can fund a startup, but instead of business revenue, you can use personal income to qualify. And that's exactly what this kind of loan stacking is based on. It's not based on your business having revenue. If your business has revenue, look at revenue lending, look at term loans, look at fund box credit lines, look at SBA loans. But if your business is pre-revenue, little bit of revenue or no revenue, then you really want to look at stuff that's based on your personal income instead of your revenue, or another factor, right? I talk about this stuff all the time. You can get funding based on collateral assets like cryptocurrency, stocks, bonds, 401ks, IRAs. You can get financing based on good credit line hybrid, right? But again, if you don't want to go to those areas, you need even more money. You don't have collateral, you don't have good credit. Then we come back down and we start looking at what else you may have, which is personal income. And that's one of the most important things I can tell you here is that when we're trying to get money for you and your business, you have to look at what your strengths are. And by the way, hello to Mike South from St. Louis coming in, and Clint is in the house as well. If you guys give me your company name here in the stream, I'll give you a shout out on the stream as well. So the thing is it really comes down to strength. When you're trying to get money for your business in the business world, there's three primary strengths: cash flow, credit, collateral. That's the main things that lenders look at. And you only need one. So if you have collateral assets like stocks, bonds, 401ks, IRAs, cryptocurrency, any assets you may have, maybe a business license, a professional license, like you're a doctor, maybe you have a lease on a building, you're able to use that as collateral. You get the idea. It's basically you have some kind of asset that can be served up as collateral. Now, when you own an existing business, a lot of things can work. You might have inventory, you might have equipment, you might have account receivables, right? You might have a customer list. There's a lot of assets you are building as you grow a business. But if you're just launching a business, you don't have a lot of those business assets. So you can still get money based on personal assets like stocks, bonds, 401ks, IRAs, cryptocurrency. That's one way to get money. All this asset-based or collateral-based lending. The second type of money that you're able to get is based on good credit. And that's a good example is credit line hybrid, where you're able to basically do credit card stacking and you're able to get $50,000, $100,000, $150,000 in financing just based on you have good personal credit and pretty decently high consumer credit card limits. Okay, so that's the second C, credit, collateral. The third C is cash flow, right? And cash flow is what you'd expect it to be. It's that you have revenue. It's that you have bank statements, you have tax returns, and you can show revenue in your business, and the revenue is consistent or it's growing. And this opens up revenue lending and merchant cash advances and term loans and lines of credit, and private money becomes available for you in a lot of cases in this position. So an SBA loan. So all this money is based on you having cash flow, right? But if you don't have cash flow credit or collateral, well, then business credit, grants, crowdfunding, those kind of options come into play. But an alternative option is you can also use your personal income instead of revenue. And this is basically personal loans. Now, a lot of places offer personal and business loans. The exact same place offers both, but one's based on your income and one's based on your revenue. So what you have to look at is, what is your strength? If you don't have cash flow, if you don't have credit, if you don't have collateral, well, then you might want to base it on having consistent income, meaning personal income. And at that point, you're going to really fall into more of a personal loan category, because the loans you're getting are based on personal income instead of a business loan that is based on business revenue. That's a lot of air quotes in one thing that I just said over the course of 2 minutes. But it's very true, right? I mean, the reality is you have cash flow in the business, you get cash flow financing. You don't, you have personal income, then you're looking at personal loans because they're based on personal income instead. By the way, Kate Ann is in the house with 3G Business Consulting in Southern California. Thanks for coming and saying hello. Queen is in the house from Royalty Business Inc. from Paramount, California. Thanks for coming in. And Vinny, yes, this is recorded. You're watching on YouTube, and this will be available on our YouTube channel. It's actually going live right now on our YouTube channel. So when we talk about personal loan stacking, here's what we're doing. Instead of going out and getting one personal loan, we are basically stacking loans from multiple different lenders to be able to get even more money. One of the biggest mistakes I see business owners make is they try to get all the money that they want from one source. I need $1 million. I'm going to try to go get $1 million from one source. But the more money you borrow from one source, the less likely you are to get approved, because that one source has too much exposure. They want to limit their exposure. So they'd rather take, instead of giving one business $1 million, they would rather give 5 businesses $200,000 and diversify the risk. That way, even if one of those clients defaults and the other 4 pay through, well, they don't really lose their butt. But if you default on the whole $1 million, they do lose their butt. And that's why, especially in these larger loan amounts, they're usually SBA guaranteed, where SBA guarantees that if loan defaults, they'll pay up to 90% of whatever that defaulted amount is. So a lot of lenders just don't want to lend a lot of money to one person. They want to diversify. And the greater the risk you are, i.e. being a newer business, or being somebody that has a stable income that maybe you don't have a business yet, then in those circumstances, you're just higher risk. It's harder to get all the money you want from one source. And this is where stacking comes into play, because credit card stacking, personal loan stacking, we're going to get multiple approvals from multiple sources to overall basically get us more money. Now, we're doing it simultaneously though. You see, if one lender knows that we've done it and they've got money from another lender, then they're less likely to give us any money, because they don't want to give us money if they know that we're out there getting money from their competitors and from other sources. Because again, it's risky. If they're evaluating my income and making the decision of how much I can qualify for, then what they don't know is that I'm out there getting another loan, and that other loan is calculated into my debt to income ratio. So if I go get a loan today and in 3 days I go to get another personal loan, that other personal loan lender knows I got the first loan. And when they look at the fact that I just took on all that other debt, now they want me to give them more debt, then they're less likely to give me any kind of approval. So with personal loan stacking, we're stacking loans. We're getting approved with multiple loans from multiple sources, but we're doing it all at one time. So then that way, the other loan that we've already obtained isn't interfering with the new loan that we're actually getting. Now, you got to be careful here. We want to do everything on the uppity up. We want to be legal, right? We want to be ethical. So the lender might say, hey, do you already have any other loans we don't know about? They might ask that in part of the qualification process. You never want to lie about any of that. This isn't a way to game the system. It's not a way to commit fraud or do any of these unethical, illegal practices. This is just saying that you can oftentimes get more money if you're applying for multiple sources at exactly the same time and accepting multiple offers at exactly the same time. And that's exactly what personal loan stacking is. So instead of relying on one lender to give me $30K or give me $100K, I'm relying on 3 lenders to give me like $30,000, $35,000 a piece. And this way it helps them because they're not inclined to give me the full amount anyways. They want to diversify the risk. And it helps me because I'm relying on multiple different sources to give me approvals, which helps me get even more money than I'd ever get from just one source themselves, right? So it's very important. So that's really what personal loan stacking is. We're getting multiple different loans all at the same time. Therefore, lenders are diversifying their risk, and we are still able to get the amount of money that we want. Now, who's it for? Well, ultimately, it's for a lot of people. You might want a personal loan for your own personal reasons, right? As a matter of fact, one of the influencers that refers a lot of business to us, he said, man, I love this personal loan stacking. I'm going to get it to put a pool. in the ground. And I said, there's specified financing just to put pools in the ground. He said, I don't care. Like, this works better for me than that. And I said, great. And we did it. We help them, right? So there's a lot of personal purposes that you may use the money for. But for the sake of this conversation, it's really good for business owners that need working capital without qualifying for a business loan, without needing revenue, without needing business assets as well. You don't need those things that are typically needed to qualify for a business loan. It's really good for real estate investors too. A lot of our real estate investor clients are killing this because they're in high-risk industries that make it very difficult to get other kind of business financing, right? A lot of lenders don't want to lend to real estate investors because they don't have consistent cash flow. They might do a deal here. They might do a deal 3 months from now, but they don't have any kind of consistent financing or consistent revenue coming in. So it's also for higher risk industries like real estate investors, where it's harder to get money from other places, but they're still able to, based on their personal income, be able to qualify. It's also really good for professionals that are looking to consolidate high interest debt with strategic stacking. So you're able to come in and do consolidation. So maybe you're trying to consolidate stuff into one loan or a few loans instead of having a lot of high interest loans or cards out there. It's very good for that purpose as well. And it's also good for borrowers that just don't qualify for as much money as they want to get, which is like 99% of people I talk to. Everybody wants more than you can qualify for. And that's because, again, so many people are set in their ways of trying to get all the money they want from one source. But in this case, it really helps because what happens now is you're getting money from multiple sources. So it's easier to get the amounts that you're really trying to get because those lenders are diversifying their risk. They're not inclined to give you as much money, but you're still getting it because you're getting it from multiple different sources. So those are some of the most common scenarios, right? Business owners needing working capital, business owners needing startup capital, real estate investors, other high-risk industries, professionals looking to do some kind of consolidation, or even borrowers who want larger loan amounts than they're actually able to get. So what does this involve? What does it take to actually be able to qualify and get approved? Typically, you need pretty good credit to get credit card, personal loans, or personal loan stacking. You can get approved with some sources with 650, 660 scores, but a lot of the better lenders, they're going to give you better terms, are typically going to be about 680 FICO scores. So in a lot of cases, you're able to get approved as low as 650 to 680 range. 680 and higher is going to get you way more capital. So if you're at 650, you could pay off some credit cards or do some things to get your score above 680, do it, because it's going to give you a way better chance of getting higher approval amounts. You've got to be 18 years of age. I'd assume that you are. You also need to have stable income. You need to have a stable job, 6 to 12 months at least employed in the job that you're at, and you need to really be getting W-2 pay. Now, don't get me wrong. Okay, I personally went out and tested this with personal loans where part of my income was W-2 and part of my income was 1099. And I was still able to get approved. And they even took my 1099 income into account. So it depends on the lender. But really, you're better off if you're getting a W-2 pay. Because if you're a 1099, they're going to want to see your tax returns. They're going to want to look to see what you're writing off and what your net is. But it does work better for people that are W-2. Although if you're self-employed or 1099, it could work for you. But again, they're more inclined to look at your taxes and the net of what you're collecting if you're not W-2. So it definitely works good if you have stable income. And if you're more on the W-2 side than you're on the 1099. Now, they're going to ask you for pay stubs. They're probably going to ask you for 1 to 2 years worth of tax returns too. Sometimes all they want is pay stubs. And they're going to look at those pay stubs and make the decision based on the revenue that you're actually, or the income that you're bringing in. Right? Now, keep in mind that this is how all lenders lend, right? Lenders lend based on what you can afford to pay. So they're going to be looking at your credit report, looking at your debt to income ratios. They're going to be looking at your income, and then all of that is going to go into their own unique algorithms that's going to determine how much money you're actually able to get approved for. And they're going to be looking at your credit history, and they're going to want it to be pretty strong. They're going to show that you have an ability to pay back lenders and that you are paying people back, not that you're defaulting. Look, you don't have to have perfect credit. It's okay to have medical collections and some of these things, but any kind of personal or business loan, when you start showing that you're going late or defaulting on major debt from major lenders like Bank of America, Chase, these kind of guys, it's problematic. Like if they see that you're defaulting on other personal loans or other loans right now that's showing your credit report, or that you've recently been going late, those are strong indicators of problems. So it's okay to not have perfect credit. But again, if you got recent late payments on credit cards, recent late payments on loans, it's going to be problematic. You should be going in showing that you're able to manage your own existing debt that you have now. Because let's be honest, like if you can't manage the debt you have right now, then you probably shouldn't be taking on more debt. That's from a lender's perspective. They're going to say, well, how can you pay us if you can't even pay the people you have, right? So your credit report kind of needs to reflect that. Hey, I had a medical collection here and there. It's okay. No big deal. Hey, I had late payments 5 years ago. My credit report. It's okay. But if you're coming in with recent late payments on credit cards and through major banks and also other kind of loans, it definitely is going to be problematic for you being able to get approved. They're also going to look at your debt to income ratio. Now, there's no hard, fast rules of what they're looking for here. But again, they're looking to make sure that you have enough money with disposable income to actually be able to pay those debts, right? So if you start to get into really, really high debt ratios, 60, 70, 80%, you're probably not going to get approved because they know you have to have part of your income to pay like the stuff that's not showing on your credit report. So it's going to be harder and harder to get approved the more debt you have and the higher your debt payments are on your credit report. And again, in relation to your income. It's okay to have a lot of personal loans or a lot of other debt outstanding and have high payments as long as your income reflects that. But the higher your debt becomes, your debt payments become versus your income, the harder it's going to be to get any kind of loan because, again, they're going to see that you're going to really struggle to be able to pay it. And, again, you should be a U.S. citizen. You should also be or a permanent resident alien. So, and Shan Da Man is in the house from Aloha from Hawaii. Shan Da Man, thanks for coming in and saying hello. Okay, now the other thing we're going to look at is what are some of the benefits here of personal loan stacking? Well, you can access a larger amount of funding than you'd ever get on your own to one source. And that is the major benefit of loan stacking. We stack to get higher approvals. It's just that simple. If I go get one personal loan, I might get 30K, 50K, whatever it may be. But if I go to get 3 personal loans and stack them, then I'm able to get 150K. I'm able to get triple what I get from just one source. So it is the major benefit of personal loan stacking is to qualify for even more money than I would ever get from just one source. Another is flexibility and options, repayment terms, structure, right? Every lender offers me something different. The time I have to pay them back, the interest that I'm actually going to pay them, what my payment amounts are going to be. I can go to 3, 4, 5 lenders and I'm going to get 3, 4, 5 completely different approvals. So sometimes it makes it more affordable to stack because I know I need 100 grand. This lender's got the best terms, but they're only giving me 35K. Well, I want the lender that's going to give me the best terms, but I still need my 100. So I'm going to grab my 35K and grab 2 more approvals too that aren't as favorable in terms. But again, it gives me a little bit more versatility, a little bit more flexibility because I'm getting approvals through multiple sources. Now, another benefit here is that when I pay these loans down, then it's going to be way easier for me to get more personal loans in the future. Look, I've used Lending Club as an example of this in the past many times, not many times, but a few times. And the first time I went to get Lending Club, it wasn't hard for me to get approved. But as I paid that through time and paid that loan off, it was really easy for me to go back to them and get more money whenever I wanted it, right? So, and I did this, and I experiment with a lot of personal and business finances, so I come here and tell you the stories. And Lending Club is one I can tell you that I've had a phenomenal experience with. I've had no issues with them the few times I've obtained financing for them. And like any other kind of lender, it's easier to get more and more money whenever you're actually proven that you could pay them back. So the more money you're actually getting from that funding source, the easier it is going to be to go back and get even more approvals from them. And this is a benefit of personal loan stacking because we're basically building relationships with multiple of these sources. So if I go out and I get a loan through Lending Club and Prosper at the same time, well, now I'm building a relationship with Prosper and Lending Club. And as I pay those loans down, it's going to be really easy for me to go back to each one of those sources and get more money. And I talk about this a lot when I talk about loan stacking and credit card stacking. I talk about going and opening bank accounts at multiple different locations. What I'm saying is the more relationships you have with lenders, the easier it is for those lenders to lend you money. So you should always be creating relationships with multiple different types of lenders. As a matter of fact, one of the strategies I teach about personal loan stacking is that you should go out to at least 3 major banks, Chase, Bank of America, for example, Regions Bank. Then you should go into 3 regional banks, right? Like, Bank of Tampa, for example, whatever it may be, right? 3 of these regional banks. Then we should go to 3 credit unions, right? So we can maybe go to whatever credit union. Right down here, we've got McDill Credit Union, a Federal Credit Union. So this way you've got like maybe 9 relationships with lenders, big banks, regional banks, credit unions. And then as you build it, you have accounts with them and you're making deposits and withdrawing money. Then when I go with good credit to apply for them, it's really not as hard. It's way easier to get approved for credit cards, loans, and lines. So again, this is why I say go out and create these relationships. Now, don't get me wrong. That's a kind of a different strategy, because building bank accounts or getting bank accounts with multiple banks, going into them to apply for financing, it's not a bad way to get the financing you need. But nowadays, a lot of personal loan stacking isn't coming from the big banks. It's coming from fintech lenders. It's coming from lenders like Prosper. It's coming from lenders like Lending Club, right? We look at lenders like SoFi, for example. So these are all fintech lenders that are using their own algorithms, their own technology to assess your risk. And these are way easier to get approved for than what you're typically going to be dealing with the big conventional banks, right? So I don't think either one of those strategies is bad, to go open bank accounts and build relationships with multiple banks and then go out and get some of these fintech loans as well. And sometimes when you go to do your mass application day, you may want to apply for all of those, the 9 that you have relationships with, the big banks, the regional banks, and the credit unions, and go and try 3 or 4 fintech sources as well. But again, the key is to build relationships with as many sources as you can. You want to be thinking about fintech lenders. You want to be thinking about big banks. We want to think about regional banks. We want to think about credit unions as well. So hopefully that helps you there. Now, Queen says, hey, these are awesome tips. Thanks, I'm glad. I wanted to find out how I appreciate that, Queen. Thank you very much. And Lonnie says, hey, I removed collections and only have 2 inquiries and need a personal loan of $2,000 to lower utilization. I want to do this, then sign up Credit Suite. Is that a good strategy? So I remove questions. It depends on what your credit score is. That's what it really comes down to. Now, if you go, there's a lot of there are definitely subprime lenders out there that will lend you personal loans that you could definitely use for that amount of money. So absolutely, it's a good strategy. If you are actually coming down and inquiries and collections, that should help your credit score. And then there's definitely some subprime, and you could even type in subprime personal loans. And subprime personal loans will be able to get you to the goal you're trying to get to as well. Okay. And Lonnie says, hey, McKinnis Enterprises here. Love the content. Appreciate that. And Queen says, that's the best way to build a great relationship with these banks. Credit unions are the best with the lowest interest rates. And number 1, I agree. I love credit unions. I think credit unions are the best. And being former military, there's a lot of options I have with good USAA and so many other good credit unions out there. There's also benefits of regional banks, right? Regional banks are trying a little harder. A lot of your regional banks are trying to get bought by the big banks. So you got to keep in mind that regional banks have more of a benefit by you opening accounts with them than anybody else in anybody else between regional big banks and credit unions. So there's a benefit of everything when you're going and opening accounts with big banks, regional banks, and credit unions. Credit unions do have the better terms. To Queen's point, they really do have better interest rates. But regional banks try harder to appease you and get you to open more accounts and deposit money into them because they want to get acquired, typically. Bank of Tampa is not going to be here 10 years from now. It's going to get bought up by another major bank. That's how banking works. As these banks come in, they get all these depositors there, and then they get acquired by a bigger bank. That's that entire model. So regional banks kind of try harder, and big banks kind of have deeper pockets. So there's a lot of benefits with having all these different kind of accounts you have. The other benefit here with personal loan stacking is there's no collateral required. You do not need to have any kind of personal or business asset that serves up as collateral. And that's a big deal because a lot of other kind of financing out there, you need to have collateral. For this kind of financing, you don't. And another benefit is it's super fast funding. I mean, super fast funding. You can go to a Lending Club of the world, a SoFi of the world. You can go to one of these sources and you legitimately get funding in 72 hours or less. Legitimately. And a lot of them do a soft credit pull. So they don't even put the hard inquiry on your credit report. And by the way, if you're going to go out and do loan stacking, it's better that you do the soft inquiry than the hard inquiry because it's going to have less of an impact on your credit. And it doesn't show the outside world that you're out there getting all that money at one time. Don't be deceived. Lenders still know when you're inquiring with a bank, another bank to get a loan. That's why you have to do these applications all at once, because if you're spreading them out even a day or 2 days or 3 days, even though you might get a soft inquiry from Chase, Bank of America still knows you apply to Chase because they're all part of a third-party data aggregator that they all share information for. So keep that in mind. It's why you got to do it all at once. And soft pulls are better than hard credit pulls, which means a soft pull, the outside world doesn't see it, doesn't show in your credit report. A hard pull, they do. But lenders, even if it's a soft pull, still know you're inquiring with another lender. So keep that in mind as well. So a lot of benefits. Risk and considerations, right? Managing multiple payments can be a little bit complex, right? And also taking on more debt than you can handle, not a good thing. So if I'm going to apply for Lending Club might only approve me for $50K because that's what my debt ratio shows I can afford. Then if I go out and get another $50K through Prosper, well, then it's problematic because now I might not be able to afford those payments. And that's why I was only approved at 50K at one source, because they know I can't afford more. So getting overextended with this is a problem and something you have to look out for. You can't take on more debt and higher payments than you can actually afford. And you never want to say, hey, I know I can't afford these payments, but I'm going to do it anyways because I think my business is going to generate X amount of revenue to cover it. You can't do that. Because one thing I've learned in running a lot of businesses and building and exiting 7- and 8-figure businesses is that things take at least twice as long as you think they will take, and they cost at least twice as much money as you think they will. I talk to a lot of business owners that think they're going to be cash flow positive in 6 months, and 2 years in, they still aren't. So you got to be careful. You don't want to overextend yourself, take on more debt than you can actually afford. You want to make sure you understand that you're managing multiple payments. So auto pay makes it essential and helpful for you there as well. You also need to keep in mind that some loan applications have hard credit pulls. So if you're out there getting 3, 4, 5 more different kind of loans, well, then this is going to put a lot of inquiries on your credit report. That's going to adversely affect your ability to use that credit report for other kinds of business credit and our business financing and personal financing for potentially 6 months or more. So some things to think about there. Okay, and Matt says, SoFi, soft pull, Prosper, soft pull. I'm not sure. To be honest with you, I have to look. But if I actually go to ChatGPT or you go to Google and say, does SoFi do a soft pull? Does Prosper do a soft pull? You'll know. I'm pretty sure both do soft pull, but I can't say 100%. I just don't know. I, unfortunately, off the top of my head, do not know all these sources and whether they do hard and soft pull, and here's why. Because they all offer different products. And SoFi is not usually a soft pull or hard pull. SoFi is more like they offer a lot of different products. Some might have soft pull, some might have hard pull. So I just don't know that off the top of my head. Can't help you on that, Matt. Okay, and Lonnie says, hey, TransUnion 690. So Lonnie, you're going to have no problem getting personal loan stacking. The amount of money that you get approved for. Lonnie, as a matter of fact, you might want to check out creditsuite.com/CLH. That's creditsuite.com/CLH. Because with those kind of credit scores, you might even be able to qualify for credit card stacking as well. But you shouldn't have a hard time getting personal loan stacking as well. And if you go to creditsuite.com/CLH, our team can talk to you because you might be able to qualify. We might be able to just help you with the personal loan stacking and the credit card stacking as well, or at least assess both those options for you. So the other thing to keep in mind is that you have higher than average interest rates here. Now, what is average is tough to say. But if I'm going through an SBA loan and I've got collateral and everything I needed to get an SBA loan, but anytime I'm securing a loan with collateral, it's usually going to give me better terms, better interest rates, lower interest rates, longer terms than if I don't have collateral. So keep that in mind as well. A lot of these are not collateral, they're unsecured, but the problem there is your interest rates can be a little bit higher than if you actually were providing collateral. And again, the other thing you want to think about is that multiple open loans can lower your credit score and your debt to income ratio. Whenever you get a loan on your personal credit report, you're always going to hurt your scores temporarily. And that's because of utilization. A lot of people think that the utilization aspect of your FICO score, which is 30% of your FICO score, a lot of people think that that's only for revolving credit cards. It's not true. The utilization aspect of your personal FICO score looks at everything you have, including loans. This is why whenever you go to get a car loan or a mortgage, you're always going to lower your payments, your credit scores considerably, because the problem at that point is that you're getting a loan for $100K, you owe $100K because you're utilized at 100%. That lowers your credit score temporarily. And that's why for 2 to 3 years after you get a mortgage or a car loan, your credit scores are still going to be lower than typically you got before you got that car loan and mortgage. And by the way, it's also why I like to double up and do more things at once. Like when I go get new cars, I usually get both of my cars at exactly the same time. Because I know that once one car loan hits my credit report, it's going to lower my scores and make it harder to get another one months down the road. So I always typically like to have an exotic car, and I like to have like my main family car. And when I do that, I usually like to go get both cars at almost always the same time. Okay. And that's the way I am. Like when I look at when I'm going to use my credit report in the future, and I try to make sure that I get whatever loans I need at the same point in time, because I know my score is going to be lower for 2 years after. So some things to keep in mind. Personal loans going to lower your personal scores the same as any other kind of loan actually absolutely does. And you also need to keep in mind, because again, some lenders are going to prohibit stacking. So you're going to have to sign off on something stating that you're not going to apply anywhere else. So you have no active loan applications or whatever it may be. So look at the fine print of what you're applying for. You don't want to commit fraud. You don't want to do unethical things. I don't want to go get a loan at SoFi, and then the application says, hey, if you're trying to get another loan at the same time and we find out we're going to pull this loan back, like you don't want that to happen. Then you go get the loan and then all of a sudden it becomes problematic and they want all those funds back because you ain't got a loan somewhere else. So look at the fine print as well. Make sure you're not dealing with a lender that restricts or that has specific language that prevents us. Most don't, just so you know, most don't prevent this. But again, it's at least something to look out for. Otherwise, they may pull all those funds back and want all their money back, right? And then you got a problem. So some things to look out for as well. So there you have it. Really, that's a lot of the things that you need to know about personal loan stacking. You know what it is. You know how it works. You know why you do it. You know the benefits. You know the drawbacks, the negatives. You know what it takes to qualify. We've talked about, a lot of different options you can go through here to get it. Talking about major banks, talked about regional banks and credit unions. We talked about fintech lenders as well. We even talked about a lot of specific sources that offer these kind of loans. So if you want to take a next step, first of all, if we can help you along the way, let us know. Here at Credit Suite, that's exactly what we do, is that we help you get funded. We deal with personal loans. We deal with subprime personal loans. We deal with personal loan stacking. We deal with all of that. So if we can help you along the way, feel free to give us a call or go to creditsuite.com/get funding. That's creditsuite.com/get funding. And I'm going to go ahead and throw this QR code up right here. You can also go to creditsuite.com/consult to talk to our team. But if you don't want to talk to anybody, if you just want to submit the application, go to creditsuite.com/get funding. And our team can talk to you about credit card stacking, personal loans, subprime personal loan stacking, all of those kind of things as well. All you have to do is scan this QR code or again, go directly to creditsuite.com/get funding as well. And outside of that, you also now have all the information you need to go out and work on personal loan stacking yourself as well. More training about different kinds of lenders and things like that to apply for. This should give you a lot of what you need to actually be able to succeed. So if you got value from this training, smash the like button and subscribe. And let me make sure I have any other questions I want to get wrapped up as well. And Lonnie says, hey, I have experience 620, IFAC 687. Okay, so with those scores, you're probably not going to get credit card stacking, but you very could get personal loan stacking or subprime personal loans. So you can go to creditsuite.com/get funding. Or what you want to do, Lonnie, is you want to go and look for those people that only look for TransUnion to offer personal loans. Which personal loan source only looks at TransUnion? Since that's your highest, that will get you where you need to be. And you can also just talk to our team at creditsuite.com/get funding. We can help you as well. You might also want to look at subprime personal loans and type that into search to find some options there, just because a couple of your scores are below that 680 mark that a lot of the lenders want to see with this product. So I hope you got value from this training. If so, smash the like button and make sure you subscribe. And keep your eye out for our next training. We're talking about more cool ways to get the money you need to start and grow your business.